Today, my guest is Anthony Scandariato. Anthony is the co-founder of Red Knight Properties. They're a multifamily syndication firm that's vertically integrated, doing both investing and property management. And in a moment, we're going to speak with Anthony about both multifamily and property management, more specifically. But first, a quick reminder, if you like this show, CREPN Radio, there are a couple things you can do to help. You can like, share, and subscribe. And as always, please consider leaving a comment. We love to hear from our listeners. And also, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on the YouTube at Commercial Real Estate Pro Network. And also, please consider subscribing. It always helps if we can grow the subscribers so we can also attract more listeners and viewers as well. With that, I want to welcome my guest. Anthony, welcome to CREPN Radio.
Great. Thanks for having me, Darren.
Well, I appreciate you doing this today. I'm looking forward to our talk. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. So Darren gave a great introduction, but in a nutshell, Red Knight Properties is a boutique, value add, multifamily and mixed use real estate investment and property management firm. So we're based out of northern New Jersey, about an hour outside of Midtown Manhattan, west of Midtown, and we own and manage ourselves about 200 apartment units, as well as mixed use properties. And by mixed use, I mean apartments above and retail on the bottom in both suburban and more CBD infill locations. We've been growing. We've been in business, for me full time. I was working for another real estate sponsor for a little over 5 years over the past, since last year, and I went full time with Red Knight this year. So we're continuing to find good opportunities, and our focus is on, B and C workforce housing, apartments with average rents anywhere from, 1,000 to 1,500 in northern New Jersey.
Got it. Well, I wanted to, if we could, given the fact that you guys are vertically integrated and do both the operation and the management of your properties. I wonder if you could speak to kind of the some of the particulars with real estate management and how you made the decision to do that, and then how you find that it helps with your overall operations.
Yeah. So the decision to self-manage was the locality. So our properties are within 30 minutes to an hour of where I reside and my partner, Brian, resides. So location-wise, it made sense. And also from a investment standpoint, the projects that we're working on do require capital improvements and a very strategic turnaround when you're trying to, sometimes in cases, rent increases have gone up 30-40% at some of our properties. And in order to get those increases, you have to be creative. You have to understand, rent control laws, if any. You have to, just really be on top of your game and managing rollover. So for us, it was an easy decision to, okay, once we're done with the value add on our buildings, and we've gone through, cycles on 3 different buildings, already. Once we go through the value add, we stabilize, we either refinance or sell. Typically it's refinance, and then, if we get all our money back, we can be flexible with the holding period. But once we're stabilized and the business plan is executed, then we can pass on the management. But we want to be hands-on, and we want to make sure we're managing the properties correctly, because I can't tell you how many times I've seen, sponsors, operators just passing along the management to a third party. Now, if you buy an out of state, it might make more sense, and they're very reputable. But just because we were so local and I can drive there, I can get in my car and be there in a half hour. It just made more sense. The only thing that I don't really do in-house is the leasing, and because it's a big time consumer. We outsource that to a third-party brokerage, which is essentially an extension of Red Knight, but at no cost to me, because in a market where I am in northern New Jersey, 99% of the time tenants pay the 1 month realtor fee. So it's really at no cost to me.
Got it. I thought I heard you say in there when you're working through a value add, you guys you manage the property through the value add and getting it leased up, but then do you consider turning over to a third party, or did I hear that right?
Yeah. Once we're done, we haven't done it yet.
Okay.
We might do it in the future, but we're continuing to self-manage. But to be honest, once you get the value add up, the properties are kind of on cruise control, depending upon how large they are and what your staff looks like. But if you're buying, in our case, we started out buying, 10 family after 10 family after 10 family. So, it got to a point where we had 70 of them, and we're still able to manage it. It's important to have your systems in place. So if you're tracking all this rent roll and expiration schedules and payment schedules, outstanding balances on a spreadsheet, it's not going to work. You got to get property management software, and we use Buildium right now. So if we didn't have that, we would be dead in the water.
Yeah, no, it can get pretty sloppy in a hurry if you don't have an organized system with that. What about the value add? Are you guys turning that over to a general? Are you managing that on a artisan contractor by contractor? Can you speak a little bit about that?
Yeah. So we have our set of contractors and also subs. It depends upon what job it is. For the most part, we're not doing anything too heavy. Mostly, carpet paint, new countertops, maybe a new sink, maybe paint the cabinets. So we work with, we have a few different contractors in our Rolodex, a few different GC. We usually do work with GCs, and then we manage the construction of that. So, oversee them. So essentially we do construction management too, but our projects aren't, anything too crazy so far. So we're able to manage that process.
So more kind of cosmetic value add kind of stuff.
Yep. Goes a long way though. Goes a long way.
No, it's usually the kind of stuff you can charge more rent for, right? As opposed to
Oh yeah,
big system stuff that's hidden behind the walls at that's supposed to be there, as opposed to nice new countertops or paint or floor coverings.
correct.
When you guys are searching for a property, or when you find one and you're going through your due diligence, do you feel like being as invested as you are in property management, that's given you a kind of a leg up, or is it giving you a better understanding going in as to what's going to be needed as far as trying to estimate, or do you still get your contractors involved with getting bids and all that, or how do you how's that help you out? How's it work?
Yeah, no, we for underwriting, yeah, it helps a lot for sure, because you know how much here's the type of laminate I want to use. What's my labor going to cost? What's the square footage of the apartments? What are the materials going to cost? It's definitely has the advantages to underwrite better, but we still go in and we do bid out, each of our unit turns or projects. For example, we had like an exterior landscaping project where we were ripping out sidewalks and putting, new sidewalks, and also what's it called, stonework. So we do bid them out, but as you start bidding out projects, you kind of understand in general how much this is going to cost and that's going to cost. So you kind of get more familiar with it, and every location is different. So cost of labor is different in New Jersey as it would be in Ohio or wherever. So it's I kind of actually have a chart that breaks down labor and by part. So I kind of use that for my guidelines, but we're getting used to understanding what in general things cost. So
Gotcha. You mentioned 10 unit properties. Are the majority of your properties like close to a 10 unit, or how do they vary in size?
um, no, so that's just how we started. I mean, personally, I started with two families, but my partner and I started with the 10 unit, and then we bought like four other 10 to 20 units together, and then we ended up we mentioned syndication. Syndication is just pooling partners and resources together and investors together to go after a larger property. So we did our first syndication in December of 19 actually, and under contract for a second one, which should close next month, and that's April. So yeah, I mean that's essentially what we do, and as you start to produce and you develop a track record, which we have. We've had two refinance events where we pulled out 140% of our equity on one deal, and about to pull out 110% of our equity, and we only owned it for a year. And then I've sold something, it was like a 40 IRR. So once you develop more of a track record, you can, um, present yourself better, and more doors open for you, and to do larger deals. So we just started out buying the twos and the tens and the 20s, and like the syndication we closed was a 50. The next one we're closing on is a 64. So it's gradually getting bigger.
Got it. Have you found investors are more receptive to your uh, or to working with you or investing with you, given your steady increase in growth?
Yeah, no, absolutely. That helps. But like I said, the most important thing, Darren, is just track record. You bought this property. What did you do to it to add value, and what were the returns? So that's what it comes down to at the end of the day. So we just want to continue to provide solid returns and make everybody happy. And you can't complain about pulling all your money out plus an additional 40% in a year, and still own the building and collect, cash flow. You just can't complain. So, we want to do more deals like that. That was kind of an anomaly, but now a second deal is similar, and the syndication that I closed on, it looks like if we continue the way we are, we've already turned over 40% of the rent roll to new rents, and I've only owned it for 3 months. So if we continue the way that we are, we're probably looking at a refi, I mean, by the end of the year. And I projected to do a refi, in 2 years. So um, just under promise and over deliver is what we always say.
No, I'm sure most investors would be happy with that. Are you finding that most of the investors are willing to reinvest uh, the uh, the equity when you're returning their capital?
Yep. Everybody has their own different reasons and, timing for certain things, but we don't require that. But yes, most of the times they do. Yep.
Got it. Can you speak to kind of the target, kind of what you're, you know, what you're looking for in a property, condition, asset class, uh, management, et
Yep.
cetera?
Yeah. So we're looking for, class B and C, workforce housing product, which is, not the low end of the totem pole, but kind of in the middle between, really high end stuff and decent stuff. So we focus on that, and we like, right now we're in New Jersey, and I'm not saying New Jersey has a great story in general, because it doesn't, to be honest. But there are certain pockets in the state that you can still buy at a low price per door, and a nice cap rate going in, that a lot of people don't know about. And that's where we've been targeting right now. Actually, I just got awarded a deal over the border in Pennsylvania, so we'll be moving out there. I do own a small deal in New York State as well, so kind of in the tri-state area, so to speak. But we look for properties, that of that asset class, and for rents that are below market due to whether it's poor management, or they just haven't really kept up with the building in terms of improvements. Um, I've seen very many different situations, but it's mostly mismanaged properties. Um, Off market for the most part. Some of them were marketed with the real estate broker that we picked up. But we're not buying things at the auction. We're not doing any of those short sale sort of things. It's a lot harder to do that in commercial anyway for these types of deals. But in terms of deal size, anything from like 5 to 20 million, we would close on.
Gotcha. You mentioned off market. Are you going through brokers, or are you marketing direct to sellers?
Yeah, so no, we're going through brokers 99% of the time. There's always that situation where you come across a real off-market deal, but it's just developing relationships in your network. And once you start closing on deals, people know about you, and it creates a sense of trust when you're trying to buy another property from a seller who's never worked with you before. That definitely helps. I've won deals just because of that. But 99% of the time it's from brokers, especially in, this price range. And obviously once you get to the higher price ranges, it's even more broker dependent. So.
Gotcha. And as far as your expense, stack, as far as you guys are self-managing, do you charge, in your operations, do you charge a management fee similar to if you were managing or having a third party manage the properties?
Yeah, so we actually charge, at least for, if it's a deal with other investors in it, we'll charge under what a third party would charge to manage. So we're always cognizant of that.
No, I think there's, having a charge for it totally makes sense. I was just kind of curious, how you guys use it. And I would think it would also help just spread the, or help support the operations, if you've got people that are actually engaged in doing things. And how many units do you have now?
So we have 140, and then we're closing on 64 next month. So we'll have a little over 200 units.
200? That's great. That's great. And the timeline, when was it you guys got started?
So I started about a little over a year ago. I was also working part-time, as I mentioned. I was working full-time, as I mentioned, but we didn't, I started buying slowly on the side with my partner, and then one thing led to another, and we found a really good off-market larger deal, and we put a group together and closed on it, and then that was the catalyst for making this a real business. Yeah. Yeah.
That's awesome. So, that's a pretty quick timeline as far as, growing that fast and making it happen. Sounds like you guys are known in the area as operators and have attracted, I'm assuming that the brokers are coming to you now with the fact that you have closed on multiple deals.
Yep.
Yeah.
Absolutely.
Now, is that a little different than when you first started?
Oh yeah, much different. For the most part, especially in a close-knit community in New Jersey, it's tough to get a phone call return. There's a lot of people who like to kick the tires. So yeah, you get taken a lot more seriously for sure. And even age doesn't mean anything, but a younger guy like me just walking in there and say, hey, I want to buy your property, it's $10 million. Who are you? So it's a lot easier once you can say, hey, I own this, I own that, I closed with this person, I know this person. It's a lot easier. So.
Right. No, I've talked with a couple of different people here recently, and conversation has kind of alluded to the the need to stay with it and stay in it, and consistency in order to kind of get some results. But once you begin to have those results, people start to recognize you as capable and credible, and somebody that can close and is not just, like say, kicking the tires. So that's kudos to you and sticking it through there and building up that reputation. Um, and
Thank you.
how what's the MSA as far as the size of the area that you're in?
Yeah. I mean, Northern New Jersey as a whole is, yeah, I think is, I have to actually look it up. But I know it's at least 1 million people um, in New Jersey. But just in terms of the submarket, particularly that we're invested in, the two submarkets, um, 50 to 100,000 people within a 3 mile radius.
All right. And are jobs, do you weigh, is there upside? Is there people moving into the area, or is it more of just kind of a mature, um, demographics pretty steady, or?
Yeah, it depends on the area in particular, but the areas we invest in are, yeah, people who already live there or people relocating there for work. And you have to remember we're only an hour from Manhattan, so um, it's there's so much demand all the time, and vacancies are vacancy rates are very low, especially for these types of product. Even during the last recession, vacancy rates were extremely low. Everybody needs a place to live. So yeah, I mean, it's a combination of both. And in the market we're heavily invested in is bringing actually like 6,000 jobs over the next couple of years. So we do look at employment, and if there's already a steady employment base within the local economy, we do like that, because if stuff hits the fan, then we want to make sure that people still have the ability to work and they have jobs and are able to pay the rent. So
Yeah, I know that rent's important. Um, your mixed use properties. Can you speak a little bit to you know how that's different from a straight multifamily property?
yep. So mixed use is apartments above and then stores on the bottom. In my instance, it could mean something else to somebody else. Um, but generally, if we're looking at a mixed use deal, the spread between the going in cap rate, going in yield, um, is generally like 200 to 300 basis points, which is pretty significant when you're comparing it to traditional multifamily. At least in my experience, it's definitely went down since we started buying. So there was definitely a spread, but there's a little bit more risk with the retail. If we're buying a building with retail, we're very cautious and we're very selective. The retail can't be more than like 20% of the gross total revenue of the building. And, there has to have at least a 3-year lease, depending upon who the tenant is. But most of the tenants we have are like mom and pop tenants that are service based. So nail salon, hair salon, ice cream store, can't really be disrupted by Amazon. So, or, any other e-commerce. Um, so, it's all service based for the most part. And that's generally what we look for.
Now, I would think that would be kind of a nice stabilizing factor. I would think. Or do the commercial tenants tend to be longer term?
Yeah. Yeah. Like I said, usually they sign at least 3-year leases, sometimes 5, sometimes 10, sometimes 15. Depends on, if you have a credit tenant or if it is like a mom and pop or a startup. But for the most part, we're looking at, service-based retail.
Gotcha, gotcha. Hey, Anthony, if we could, I'd like to shift gears here for a second. As I mentioned to you before we started, by day I'm an insurance broker, and with that, we
Nice.
assess risk and try and manage the risk for our clients. And there's a couple of strategies we use when we're trying to manage risk. The first is we look and see, is there a way we can avoid the risk? If that's not a possibility, we look to see if there's a way we can minimize the risk. And when neither of those are options, we look to see if there's a way we can transfer the risk. And that's where an insurance policy comes in. And I like to ask my guests if they can take a look at their situation and what they're doing and identify what they consider to be the biggest risk. And just to be clear, I'm not really looking for an insurance related answer, but more of, I'll let you kind of frame that. So if you're willing, I'd like to ask you, Anthony Scandariato, what is the biggest risk?
Yeah, I mean, the biggest risk is, to me, it's always on the buy. So you have to always buy right. You have to always run your numbers. You have to run a sensitivity analysis. You have to understand, if downside, base case, and upside, and if the downside scenario still makes sense, then it's a good deal. So the biggest risk is people not buying right. We always, and not running these analyses, because markets change, and right now they're changing every day. You have to incorporate those into your numbers, and we always do. What happens if, I can't get the rents I wanted, or what happens if I can't refinance or sell for this cap rate, and, what happens if interest rates go up, and, I have to therefore increase my exit cap by 300 basis points. Am I still going to make a decent return on my money, as opposed to putting it in the stock market? And if the answer is yes, then that checks my box. But we have a whole criteria of that. But the biggest risk is people overpaying for deals just to do a deal. Doesn't necessarily mean it's a good deal.
No, there's definitely a fear of missing out kind of a thing where people are, willing to do some silly things sometimes. So that's good advice there. Anthony, where can the people go? Where can the listeners go if they'd like to learn more or connect with you?
Sure. So they can go to our website. That's redknightproperties.com, and that's Red Knight with the K. We also have a LinkedIn page, Red Knight Properties, and we have a Facebook page, Red Knight Properties. And on our website, we have if you scroll to the bottom of the homepage, we have like a contact us form. So you can send us an inquiry there, or you have my email on there and also my partner's email. So feel free to email us. Phone number is also on there as well for our office. So happy to hear from you.
Got it. Well, Anthony, thanks for taking the time to talk today. I've enjoyed it. Learned a lot.
Thank you, Darren.
Yeah, and hope we can do it again soon.
Absolutely.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.